In this video, we're going to show you a very interesting strategy for pulling the risk out of a trade on stocks leading up to earnings, so that by the time the earnings date arrives, you'll be faced with an attractive situation that you might have not thought possible. I'm the head options trader on our trading desk here at SMB Capital in Manhattan, and the traders on our desk are constantly seeking to develop trading ideas where risk is minimized and reward is maximized. So if you're interested in a way that you can set yourself up with minimal risk on a trade while putting yourself into a position for really solid gains, you should stick around because I think you're going to find this intriguing. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so Chipotle Mexican Grill with the ticker symbol CMG was trading around 835. And as you can see, since late July, the stock price was channeling between 780 and 850. Chipotle was scheduled to release its third quarter earnings report on October 22nd, and most stocks will have an unusually large reaction to their earnings reports, as the earnings report will often be a catalyst that will cause the stock's price to break out of a range that it was in prior to the earnings report being released. Now, before we delve into this option strategy, it's important that everyone have a basic understanding of how options work. Most of you probably know something about options, but just for a really super quick review, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is trading. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. But if the stock on the expiration day of the option is not beyond the strike price of the option, then the seller just pockets the premium that he was given by the buyer. He walks away completely free of any obligation. So, for example, let's say you think that CMG will go up a lot after earnings. Well, in that case, you might buy the CMG 855 call that you can see here, which costs $27.51. But each option represents the right to buy 100 shares of CMG. And so you multiply that by 100 to get the cost of that call, which is actually a cash outlay of $2,751, $27.51 times 100. Or suppose you own CMG stock and you think that it may go down after earnings. Well, in that case, you might decide to buy that 775 CMG put for $14.52, which again is multiplied by 100 because that represents the right to sell 100 shares of CMG at any time between now and October 25th. So that put would cost 100 times that, or $1,452. Now, if CMG closes above 775, then the put will actually expire worthless because the right to sell CMG shares at 775 when the stock is trading above that is obviously a worthless right. The same thing goes for the case where CMG closes below 855 on expiration day, October 25th. In that case, the call option will expire worthless because no one will exercise their right to buy a stock at a higher price than it's trading. So those are the basics of how stock options work using CMG as an example. Now, with that in mind, suppose that on September 20th, we go in and buy both the 855 call and the 775 put on CMG, as you see. Well, that combination, buying both a call and a put above and below the market price respectively, is what is known as a strangle to options professionals. Well, the total cost of the strangle, as you can see from the calculation, is $4,203. Now, here's where it gets interesting. Remember, CMG was channeling between 780 and 850 for the last 6 weeks. So it wouldn't be unreasonable to expect that there's a decent chance that channeling would continue until the next major catalyst, which would probably be CMG's next earnings release. So what some options traders will do at this point is to go about a week out, and at the same time they buy the long call and the long put. In other words, at the same time they buy the long strangle, they'll go in and sell a short strangle at 780 and 850, the outer range of the channel on the upside and the downside of the stock's price. Now, when you do this, selling a tighter to the market strangle in the front week and buy a farther from the market strangle in the back month, that entire combination is what is known as a double diagonal. So that is how we enter the trade on September 20th, which is 33 days before earnings are going to be released and 36 days before the long straddle expires. Now, let's break down the economics of what has happened as we enter the double diagonal. As we mentioned before, the long strangle expiring on October 25th cost us $4,203. But we're simultaneously selling against that long strangle the 850 call for $471 and the 780 put for $82. So that nets down the cost of the original strangle that we bought to expire after earnings to $3,650. Okay, so that's our first trade in what's going to be a campaign, as you'll see shortly.
Before we get into how this trade actually would have turned out, I wanted to mention that we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 real-world option strategies that professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all of the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with the stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or believe it or not, even if it goes down a small percentage, you'll make your target profit. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Now just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.
Now, on our CMG trade, we move forward about a week. And as you can see, the CMG has sold off a bit down to 817, and the options that we sold last week will be expiring in about 5 hours. So to close those short options and end that part of the trade, we can buy those back very cheaply because they're so far from the money with only 5 hours to go that the whole market knows it's very unlikely the price will reach 850 in 5 hours, nor drop to 780 in a few hours. So as a result, as you can see, we buy the expiring 850 calls for just 7 cents, and we buy the expiring 780 calls for just 35 cents. So the total cost to buy those 2 short expiring options back was a total of $42. And then at the same time, we go ahead and sell the same strike prices, 850 on the calls and 780 on the puts for the next week's expiration, collecting $1.48 and $2.63 for the calls and puts respectively. Now, let's take a look at where we stand on cash flow at this point. Okay, well, we have our original long strangle cost of $42.03, and we subtract from that the cash flow we got from the first week short strangle at $850 and $780. And you remember, we brought in $553 for those. Now, to close those a week later, we just showed you that we're paying only $42. But remember, now we're also selling those same strikes into the next week. So we receive an additional $148 for the new short call and another $263 for the new short put. So the total cost of the trade is now going down to $3,281, almost $1,000 below the original cost. Now, let's move forward another week. Now, at this point, the CMG has been relatively stable, trading up slightly to 820. But again, the options we sold the week before are now going to expire in a few hours. And so they can be bought back really cheaply because they just aren't worth much. The chances of CMG getting to 850 or 7080 is remote again over the next 5 hours. So we can again buy those cheaply, 12 cents for the calls and 20 cents for the puts to close those short options and at the same time open up new short options, again, at the same strikes as we did the previous 2 weeks, 850 and 780, selling the calls for 228 this time and selling the puts for 281. So as you can see from the calculations, if we look at the cost now, you'll see that if you add in all the credits we've gotten so far from the short options and net that out of the from the cost of buying back those short options right before they expire, you'll see that our cash flow is now down to an outlay of a little over $2,800. So we move yet another week where CMG has moved up to 841 now, and we do the same thing, rolling the short calls and puts into the next week, this time paying 64 cents to close the expiring options and rolling them into the next week for incoming cash flow of $8.62. So doing the math now, adding up all of the cash we received for all the short options we sold and netting those out with the small amounts that we've had to pay to buy those short positions back, we've gotten our cash outlay on the trade now down to just a little bit over $2,000. Now that's half of our original cash outlay. Okay, so now this is where it gets really, really interesting. So finally, we get to the week before the long straddle that we bought a month ago. So the whole trade is really leading up to what's going to happen this week, because this week is also the week right before earnings takes place. In fact, earnings will be released in 4 days, while these options will actually expire after earnings in 7 days. So the implications of that are significant, because now we are, for the first time in this trade, going to be selling options that are going to expire after earnings. Now, what this means is that the options market is going to really pump up the price of those options, because look, CMG is now trading at 845 and earnings are about to be announced. So that's huge, because remember, we are repeatedly selling the 850 calls each week. So now those calls are only 5 points from the price of the stock with only 4 days to go before earnings. And even those 780 puts are really pumped up in price, because even though they are 65 points below the money, with a high price stock like CMG, a 65-point downward move is not possible if CMG has a terrible earnings report. So we're being paid hugely, as you can see, for these short options. You can see we're getting paid $27.88 for those calls and $8.81 for those puts. And since each of those options represents 100 shares, we're getting paid a whopping $3,669 for the shorts. Whereas in the previous weeks, with short options not exposed to earnings, we were getting somewhere in the neighborhood of $500 to $1,000 for the short call and the short put in the new week. Now we're getting $3,669. That's a massive increase, and that's because earnings are coming very shortly. So now it's important to understand exactly what that means. So if we look at the cash flow coming into the final week of the trade, we find something amazing. If you add the cash inflow from selling those final pumped up options in the week before expiration, you'll see something amazing, which is now, just by rolling those same strike call and put options each week from 1 week to another, we now have positive cash flow in the trade. And that positive flow is $1,517. We've basically paid ourselves back for the total cost of the original strangle that expired after expiration week. Plus, we received an additional $1,500 through this campaign of selling the options against those longs. Now, let's move forward to the expiration day of the options in this trade, all of which now expire on October 25th. So, on expiration day, the CMG closed at 792. It turns out the market did not like its earnings report. And so let's see what happens with each option. Well, the long call at 855 that we bought a month ago and the short call at 850 that we sold last week, well, those both expire worthless, because the stock is trading 60 points or so below those options. So the right to buy the CMG shares at 850 and 855 have no value. And the 780 short puts we sold last week and the 775 puts we bought a month ago, well, those expire worthless also, because they have no value. CMG is trading at 792, so no one is going to sell their shares for 780 or less when they're trading at 792, obviously. So all 4 options go out worthless, which means something great. And that is that the trade is over, but we still have our $1,500 of cash flow that we collected during the trading by the campaign of rolling those short options every week. Now, I do want to caution you, for reasons that we can go into in another video, that had CMG closed above 850 or below 780, that there was a possibility that the trade could have yielded as little as $1,000 in profit. But once we sold those final short calls and puts in expiration week, there was no way that the trade could have lost money. The minimum it would have made would have been $1,000. So what I'd like you to take away from this video is the fact that professional options traders find all sorts of ways to take advantage of the unique changes in options pricing, especially as they approach earnings. Through understanding options behavior, you can unlock a lot of potential profit scenarios that you might never have thought possible.
Just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just go ahead and head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And if you found this video helpful, don't forget to press on the subscribe button, because we're going to continue to shoot more and more videos with these kinds of valuable trade ideas in the future, and you won't want to miss them. And while you're at it, leave us a comment for what you liked about this video and what other types of videos you'd like us to produce for you in the future, and we'll see if we can make that happen.